Good afternoon, everyone. It's been a few days since I have been on YouTube. I have been very, very busy with one, getting ready for the Christmas holiday with my family, and also end of the year medical checkups, follow-ups, etc. So it's been a busy couple of weeks since I last posted. But welcome back. This is Donna from Inspiration and Networking, and today we're going to talk about the next video in the series regarding home loan financing questions. And today's topic is going to be on pay stubs, W2's, and some tax returns. So, pay stubs. Obviously, you're going to get a pay stub if you're working an hourly paid job. Pay stubs are basically your snapshot of how much money you've earned in, the most recent past. Lenders like to ask for the most recent pay stub that reflects a 30-day pay period, that shows 30 days of continuous pay. And so sometimes that includes, depending on if you're paid weekly, that's going to be like 4 pay stubs. If you're paid 2 or 3 times a month, then you're going to be you're asked to provide the most recent 2 or 3 pay stubs, depending on, again, how many times per month you're paid. They're going to look at the number of hours worked per pay stub. So many times a borrower will say to the loan officer, yes, I work a full 40-hour week and I'm paid, say $25 an hour or whatever. And the loan officer will calculate the income based on 40 hours a week at $25 an hour, and they'll come up with a gross monthly income. And for mortgage financing, home loan financing, you qualify based on gross monthly income, unless, of course, it's a self-employed borrower, and that's another topic. But anyway, and so then the processor gets the file, and the processor is going to look at the pay stubs, and they are going to see if, one, they work 40 hours a week, and sometimes they do, and sometimes the pay stub does not reflect 40 hours of work in that time period, or 80 hours if it's a 2-week period. And so, if there's PTO, paid time off, that's going to reflect on there. And so it's going to show the total number of hours during that pay period. And if it is less than 40 hours or 80 hours for 2 weeks or whatever, then the loan processor is then required to average the income based on the number of hours worked in that time period covering those pay stubs. So some people, and I can attest, this has happened a few times on a few files. Sometimes the loan officer will turn in the loan file, and again, it'll have the pay stubs in it, and they will have calculated the income based on a 40-hour work week, and the borrower does not have pay stubs that reflect that they did work 40 hours and that they didn't have paid time off to cover that time either. And so sometimes you'll get a pay stub that'll, I have gotten pay stubs that'll have maybe one of, say, 3 pay stubs with 40 hours on it. And then the next 2 will have, say, 26 hours or 35 hours. And so what a processor has to do is they have to average that. And they also have to send a letter or a verification of employment to the employer to find out why the pay hours are different on each pay stub, and was the borrower off work for any extended period of time or any period of time during the past 12 months that was not covered under paid time off. And so sometimes that all works out just fine, and many times it's amazing. Many times you run into a situation where the pay stub is incorrect, and so they have to correct it because it doesn't match the verification of employment that comes back. And so, the employer has to make that correction. But it usually happens, many times with a smaller employer, they will have to correct that pay stub and provide a revised, corrected one, and maybe a little letter that says this is what happened or whatever. So again, remember, in mortgage financing, everything has to be documented. And so, and it has to be backed up by, documentation. So anyway, but once we get past the figuring out the income that the borrower is going to qualify based on, then we look at that pay stub and we determine also, are there any deductions out of the pay stub that are outside of the normal deductions, maybe for health insurance, of course, payroll taxes, the FICA, income taxes, Social Security tax, Medicare tax, those things are going to appear on the pay stub. If there's a child support deduction, and maybe the borrower did not mention that he or she pays child support, and so that has to be determined then by a copy of the court order that reflects what that monthly child support is per month, and that and depending upon the age of the child or children and the court order, then it determines how long that duration is. And of course, if it's something that's going to end within 10 months, then we include that, of course, a documentation in the file. But generally, since it's treated it's looked at kind of like an installment type of loan, then they may go ahead and just say it's going to end in this period of time, and they're almost done with that obligation. And so but it has to be a very short period of time, just a matter of a few months, and of course it has to coincide with the child support order, and that there's no back child support, because that can go on past the age limit of the child. So anyway, it's kind of a case-by-case basis. I've rarely ever seen that happen. As a matter of fact, I don't even recall seeing that happen, but I know that it's been discussed. And so, but typically they're going to see that it matches up with the pay stub, matches up with the duration of the child support, and it is included in the debts and included in the debt to income ratio. The other thing that they look for on the pay stubs, of course, is to make sure that the information matches, that it has the employer's name on it and the address, and that all matches up with where the borrower says that they work, or if it's out of a home office or somewhere else, it needs to match the W2’s, that has to match up. The other thing that you're going to see, and if you're a salaried person, they're going to look at your base salary, and they're going to see that is, what your base salary is. And again, if there are deductions on the pay stub that correlate that there's child support, same thing applies. Going to have that child support court order so that they can make sure that, they have the correct amount, and that it is deducted from the debt to income ratio, added as a debt per month. So W2’s, again, I'm going to ask for the most recent 2 years of W2’s, and sometimes on the W2, the income is going to show perhaps greater than what it would show on the pay stub, typically, because now again, remember, W2’s are for the most recent 2 years. So the most recent 2 years W2’s, in this case, for speaking about now, would be 22 and 23, because 24 taxes have not been filed. W2’s for 2024 have not come out. So they're going to look at 2023 and 2022 W2’s. And so many times, especially on an hourly person, they're going to find that maybe there's some overtime there. And that overtime may or may not appear on the pay stub. Overtime can be counted, but it has to be consistent. There has to be a consistent 24, 2-year history of it. And so then they can count it, as long as it is something that is going to continue, to be expected to be continued. And again, a verification of employment from the employer will let us know that it's going to, or let the lender know that it's going to be something that's continued. If so, then they can include that in the borrower's income ratios. Again, salary is pretty much what it is. So, if you make $3,500 a month, and if you're paid twice a month, or 3 times a month, sometimes every other week or whatever, you know, your salary amount is going to be reflected on the pay stub, and that is what the lender is going to use to calculate your income. And the only time, you know, that would change again is if there's been any time lost from work that was not paid by paid time off. And it's pretty rare that you see that with a salaried employee, but it's possible, it can happen. W-2 forms, we touched on that, most recent 2 years. Another type of annual reporting form is what is called the 1099. It's similar to a W-2, except that it's usually provided with a retirement account. So like if you have a retirement account, you're going to be using, you know, some of that income to qualify. Then of course, along with some other supporting documentation, you know, they would look at the W or the 1099s rather to see, you know, what that was, and how much that distribution was every year. Another thing that's going to show up on a 1099 is the Social Security retirement. That too is also sometimes used as a source of verification for the Social Security retirement. And then of course, if someone is receiving commissioned income. Now, not all commissioned income is paid on a 1099. Many times it's paid on a W-2. You know, if a borrower is paid a base income and they receive commission as well, then they'll pay those together. Or there are some instances where if you are commissioned, your employer gives you a choice that they can withhold the taxes and they'll pay you on a W-2, or you can withhold the taxes and take care of that yourself and they'll pay you on a 1099. If you're paid a larger proportion of your income in commission, the lender will want to also see a copy of your most recent 2 years tax returns. Also, if you have rental income, so say you have a duplex and you rent out the other side of it, and you claim that on your taxes, they're going to want to see that as well. So that's pretty much you know, what they're going to ask for. Oh, also, many times people will work for a small business. So say maybe it's a son or a daughter, maybe the borrower is a son or a daughter or a brother or whatever, and they're working for a family member owned business, and they own a little bit of the business. Well, as long as they own less than 25% of it, then they don't need to provide the business tax returns. But if they do own 25% or more, then we're going to ask for the I talk like I'm still doing this. The lender is going to ask for the most recent 2 years business tax returns, and possibly even a profit and loss and a balance sheet for the year-to-date information on the company. So that kind of concludes today's lesson, if you will, on home mortgage financing regarding pay stubs, W-2s, 1099s, and just a brief touch on the tax returns. If you have any questions about any of this, or you have some thoughts or input, I invite you to please leave a comment. Definitely please like and subscribe. And if you know someone else who might be going through this and they're having questions and they're scratching their head and they're wondering, why am I being asked for all this? Please share a copy of this video with them. So thank you again. I appreciate you. And I look forward to seeing your comments and talking to you again soon. Take care. Bye-bye.